Thanks for having me back, everybody. Is the mic okay in the back? Good? Okay, wonderful. So as Cindy mentioned, today we want to talk about investing, and it's not necessarily a crash course, it's more kind of an introduction. The reason why I wanted to focus on this topic is because this tends to be the area that physicians are the absolute worst in across all professions. When we talk about financial literacy, managing money, understanding certain topics, physicians can actually do it and do it okay. But when it comes to figuring out where to put the money, especially when they transition from residency to attending and start that big jump in having a paycheck, they have no idea what to do. And so I think getting your mind started and understanding all of these different aspects of it now are important, and try to utilize it as a foundation for when you move forward and you actually start making money, what you want to do with it and where you think you want to go as you plan for retirement. So the first thing that I wanted to talk about was just the sheer amount of information there is out there regarding investing. If you are to turn on CNBC, you'll probably find some guy screaming about a certain stock. Or if you read today's headlines, you'll read about the 4% drop, and you have no idea what's actually happening. And the reason why there's so much information out there is because people tend to care about all the nitpicky things. When it comes down to managing your own personal finances, there's actually just a few very basic key principles you need to know about, and that's going to carry you through the rest of your life when you're talking about investing. And that's what I want to focus on here today. But first, I kind of wanted to go over some of the things that we had talked about before. So just kind of recapping the importance of your credit score. This is the main thing that you can do for yourself right now in order to make sure you have a good financial secure future. So if after you finish medical school here, you decide to stay in Rhode Island for residency and you want to buy a house. If you wanted to buy a $300,000 house in Rhode Island, you're going to take out a mortgage. When you take out that mortgage, the interest rate you pay on that mortgage is going to be based on your credit score. Now you can have a very good credit score, or you can have a mediocre credit score, which is where generally most people coming out of an educational environment come to because they haven't had any other forms of payment. So if you were to have a really good credit score versus a mediocre credit score, the difference that you'd have to pay is about $100,000 extra just on that $300,000 house. You're paying an extra third of the value of that house just based on your credit score. Now, of course, that's not what we want to do. We want to make sure that we get to that highest echelon of credit score. So what are the 5 components that make up your credit score? The first is the one that everybody knows about, and that's how well you pay your debt off in time. So if you had a credit card bill and you spend 12 months paying that back instead of the general 1 month time period, that affects your credit score. It affects 35% of how much that credit score is worth. The second thing, and it's almost as equally as important, is something called the utilization rate. And this is the one that I tend to harp on the most because I think it's the one that you can do the most damage on right now. If you have a $1,000 limit on your credit card and you're putting $500 on that credit card every single month, you're utilizing 50% of your allotted credit that you have. That's a very bad number. You want to be below 10% of your utilization rate in order to have that highest credit score. Now, there are 2 ways that you can do that. You can, of course, bring your spending down to $100 a month on that $1,000, so you're at 10%. Or the other option is to call your credit card company and tell them that you want a higher credit card limit. This might seem like something that is obscure and out of the ordinary, but in fact, you should be doing this every single year. You should be calling your credit card company and faking a story about how you've got a big product that you're about to buy, and you need to spend a lot of money and you need a higher credit score. And then you'll say, I've paid all my credit card debt on time, I just need to increase it. And they'll be like, okay, well, your $1,000's up to $2,000. All right, now it's up to $4,000. And pretty soon you can have a credit card limit up to $20,000, and you might still be putting the same $500 on it every single month, but now your utilization rate is so low that your credit score is going to jump because of it. The last few things are the length of history. So if you have a credit card that you had opened back when you were in high school that your parents helped you open up, or one that you started in undergrad, keeping that open for a long period of time is very beneficial. It shows people who are going to give you a mortgage that you can hold on to a credit card for a long period of time and pay everything off at a decent time. That's very important as well. In the same way, you also don't want to constantly be opening up new credit cards. If every time you see a promotion for a free towel when you open up a new credit card and you do it, that's going to show that you're very risky and that you're taking on a lot of credit. And excuse me, the last one is the types of credit that you have. Now, students actually do pretty well with this because with our student loans and car mortgages and all the other things that we usually have a variety of stuff. Unfortunately, this is one of the least important ones for what makes up our credit score, but we don't need to work on it that much. So for things that you can do right now to help your financial future, think about making sure you're paying off your debt on time and try to get a low utilization ratio. That's how you can help increase your credit score right now. And increasing your credit score isn't something that takes a year or 2 years. It takes a few years in order to get to that point. So if you're thinking about buying a house, you don't want to be seeing that you have to jump a couple of echelons in your credit score. You want to start thinking about that now. Question?
In terms of requesting increases in your credit line, I know online, they'll just send you emails that say enter in, these 3 things to request an increase. But I hesitate to do that because we're medical students, and so even though I pay my card on time and would qualify, I have to enter in 0 for income.
Yeah.
So do you recommend doing it in person?
I always call. I don't usually use the online one. It's much easier to talk to somebody and say, I need an increase. I also tend to use my loans as a form of income because that's how I'm paying down my debt. So putting 0 as your income, technically that's true as a medical student, but you're still gaining, you still have money that you're using to pay, and I would use that for at least a credit card portion here. Any other questions about credit score? Okay. So what we had ended last time, or the first talk about, was how we kind of put a hierarchy or a pyramid into when we actually have money. So when you are managing your money, you want to pay off really high interest debt off first, like your credit cards. If you have a credit card and it has a 17% interest rate on it, you want to get rid of that debt first. Then you want to kind of move down the rest of the list to other areas. So you want to build an emergency fund in case of the what ifs out there. You want to think about your retirement plans, your college savings, paying off other types of debt that you have, and of course investing. Now, I would argue that this doesn't necessarily have to be the exact order that you do it in, but this is kind of the areas where you can start playing around with things that you want. So when we think about investing, we think about different companies and things that we want to invest in. Now, most of the times when you think about a company that are out there, you're looking at companies that are actually at the end of their life cycle. When companies initially start, they get some funding or some investments from the very beginning and they work their way up. Then as they start making some revenue, they might have some newer investors. They might take a portion of that company. Finally, they get to a point where they're getting big enough where they want to raise a lot of money, and instead of just going to individual investors, they go to the general public. And that's something called an initial public offering. So the way that works is, say you have a company, and now it's gotten to a point where it has $100 million in value. Now that can be because it is making $100 million, it can be because their profits are $100 million, or it can be something totally obscure like the way Facebook was, where they weren't making any sort of money, but they had 1 billion people using it. So no matter how people are valuing it, they think the value of this company is $100 million. So now that company is saying, I'm going to offer the public 1 million shares. So you can have 1 share at $100, and you now own a part of this company. That's exactly what a stock is. So once you have a part of this company, you are now privy to the things that make that company grow. If that company now grows to $200 million, well, your 1 share is now worth $200. If that company is giving back dividends or part of their money that they earn, they pay you cash on it, you get a portion of that because you earn a share. So that's how you actually, that's the reason why you get a stock, because as a shareholder, you get to take part in the future value of this company. Now, once you have this future value of this company, you can make money in a couple of ways. You hold on to it, and then as that company is doing better, the demand for it increases. When the demand for it increases, the price of that share is going to increase. When you sell it, then you're getting a profit on it. So that's the most basic investment tool that we have, is buying a stock in a company. The second one that we have is a bond. So a bond is kind of like you giving a loan to somebody. Say a company was trying to build new computers for their product, and they need money for it. So they issue out a bond statement. They say, we're going to give 5% every single year if you give us $1,000. So you lend this company $1,000, and for the next 5 years, they give you $50 each year. At the end of that 5 years, you get your principal $1,000 back. So at 5 years, you now have $1,250 rather than your initial $1,000, which equates to getting a 5% return on your investment. What are the types of bonds that are out there? The most common types are the ones that the government actually gives out. So the government gives out bonds based off of the number of years that the term is for. So it can be 30 years, 2 years, 5 years, 10 years, or 1 year. These are considered some of the safest investments out there, strictly because the United States has never failed to pay back a bond. You can also have municipal bonds. These are cities and states saying, we need to build highways, so we need to raise money. Please give us $1,000 and we'll give you a % return on that. Less common and a little bit riskier are corporate bonds. These are companies kind of doing the same exact thing, saying we need to raise money, and instead of just giving away part of our company like the stocks did, we're going to try to get loans from you. The reasons why this is a little bit more riskier is generally when companies are trying to give out bonds, they're not as sure about the value of their stock. And if this company has a chance of folding and not being able to pay it back, you don't get your money back. Now, this is very rare, but it's still a little less rare than the United States government, who has never failed to give back some of its payments. And the last are money markets, and this is something I'm not really going to talk about, but it's a very low-risk investment that you can do for a very short time period. So these are your two main options when you're thinking about investing. You have stocks, where you own a percentage share of a company, and you get kind of the future value of it, or you get to sell off that stock for some sort of profit. And then you have bonds, which are kind of like loans, and then you get some sort of interest payment every single year until you get your principal value that you've given them back to you. And I'll pause here for a second to see if anybody has any questions about the two basic types of investments that you have. Okay, great. So you might have heard some terms thrown around in terms of the stock market, the DJIA, which was very helpful for me in remembering my anatomy. This is not exactly what we're talking about. We're talking about the Dow Jones Industrial Average and the S&P 500. Now, what is this? Instead of using one stock to try to figure out what's happening in the market, we tend to do averages, or these indices. So the Dow Jones is the 30 largest companies in the United States. And they put an average together and kind of see where those companies are trending. The S&P came a few years later saying it's not fair just to do the 30 largest companies. That's not representative. You should do the 500 largest. That way you get some of the smaller companies out there. So those are the two major indices that when you're hearing people talk about the stock market, this is the ones that they're talking about. How does it actually look? Well, over a 10-year period, they pretty much track exactly the same. So it's not like there's much of a difference between looking at the Dow Jones and the S&P, but you can see some slight differences between the two. The reason why I bring up different indices is because this is how investing in stocks has transitioned into, and how you'll be investing in stocks in the future. Instead of investing in one individual stock, we now think it is more beneficial to invest in a diversity of stocks. Kind of the way that the S&P is 500 stocks or the Dow Jones is 30 stocks. Instead of putting all of your money into 1, 2, or 3 stocks, put it into as many as possible. Now, this has kind of changed over the few years into some other terms you might have heard, such as mutual funds and index funds. What mutual funds tended to be were professionals would come together and say, why don't everybody here give me your money, and I'll put all of your money into 50 stocks that I think are the best stocks to own. And then I'll charge a little fee for that, but I'm definitely better at it than you, so you give me your money, and then I'll give you the returns minus, say, 2%. Well, as it turned out, I wasn't any better than any of you. So people would invest into mutual funds, pay 2 or 3%, and actually earn less than the S&P or the Dow was. So this kind of went away. Then index funds came, and index funds, essentially what they did was what I'm talking about, which is tracking the S&P or the Dow or any other index that might be out there. Except instead of a human doing it, they just have a computer do it for you. So same type of idea, all of you pool your money, give it to this computer, and they're going to trade all 500 companies on the S&P and kind of see how that trends for you. That was really beneficial for investors because they didn't have to pay that premium of 2 or 3% since the computers were doing it. It would be a lot less of a charge. And then most recently came something called the exchange traded funds. And this is now kind of the go-to investment for everybody. The ETFs are a hybrid of mutual funds and index funds. They operate like a computer trading for you, but you don't have to pool your money. You can trade them directly as if it was a stock. And they track, instead of just one index, a portion of companies. So if you said, I wanted to invest in Japanese tech companies, you can probably find an ETF that tracks just Japanese tech companies. But instead of having to buy just one of them, they would track all 50 of them or whatever it might be. So that's now what the new investments are kind of looking like. So last time I introduced two of my friends, Pete the pediatrician and Nancy the neurologist. Now Pete and Nancy both wanted to become pediatricians, but they thought they were a little bit concerned about the pay that they were going to get, especially Nancy. So Nancy decided to become a neurologist instead because she wanted a higher payment. The average salary for a pediatrician is $220,000. Average salary for a neurologist is about $270,000. Now let's say both of them decide to contribute 5% of their money. That would mean for Pete, it would be $11,000, for Nancy, a little more than $13,000. If Pete started earlier at 30 and went for 10 years at 40 versus Nancy starting at 40 and going until 70 or for 30 years at 8% interest, Pete would still come out in front with the amount of money that he would save. This is the power of starting really early and thinking about this early. We want to try to make sure you can go into whatever career you want to and not worry about your retirement because you'll understand the value of starting early and where to actually invest. Now in this example that I had used last time, there was one major thing that I had left out. How do you get that 8% interest every single year? So that's what we're going to talk about for the rest of the time today. If you were to take a look at the S&P 500 over different qualities of years, so let's say from 1928 to 2014, 1965 to 2014, or 2005 to 2014, you almost always get to 8%. That 2005 to 2014 time period also includes the Great Recession that we had in 2008, 2009, and you still get to almost 8% every single year. In fact, the S&P 500 has never had a 30-year period where you receive less than 9% return every single year. Now, of course, I'm talking about averages here. What happens if you were thinking about retirement in 2005 and you had all of your monies in stock and went until 2009? You'd have lost more than a quarter of your entire retirement portfolio at that point. So we can't just solely rely on putting all of our money into the S&P 500 and saying, I'm going to grow this at 8% every single year. We need to figure out a good way to transition and make our money safer. So the first major rule that I have for investing is that investing in the stock market is the best thing that you can do for the majority of your life. But as you transition closer to retirement, you want to become safer and safer. So how do we actually allocate where we're putting our money? I use the rule of 100. So you take 100 and you subtract your current age. I'm 28 years old. And that would be what your stock allocation would be. So that would mean that 72% of my money should go into ETFs, stocks, mutual funds, anything that's related to buying stocks of companies. 28% should be bonds, money markets. So as I get to, let's say, 70, and I'm thinking about retirement, at that point, 70% of my money should be in bonds or money markets, in safe investments. And only 30% at that point should be in the stock market. I hope you don't know who this is because these are my parents and that'd be creepy if you did. So if I were to ask about my parents and I gave them $100, my mom would stuff it underneath a mattress because she's very risk averse. My dad would find probably Bitcoin and invest in it right now. That's kind of their spectrum of how they think about risk. When we think about companies and investments, they also are on the spectrum from being risky to being less risky. Individual stocks are, of course, the most risky. You're putting all of your money on how one particular company is going to do. And I'll talk about some examples of that. Then we talk about these pooled investments, ETFs. So these can be risky depending on what sector of the market you're going to be investing in. Riskier ones tend to be ones that are a little bit smaller companies or tend to be newer technology. So if you were to invest in biotech companies kind of in the Northeast, it's a new market, that would be a little bit riskier, but also has a greater chance of return. On the opposite end, you have some large companies that tend to be more stable. ExxonMobil's not going anywhere. They'd probably be a very solid bet as you get closer to retirement. And then, of course, you have the lowest risk, kind of what we talked about. My new favorite thing that's come out is instead of having to buy bonds individually from companies, you now have ETFs that are tracing bonds. So you can buy bonds the same way that you buy stocks. So when you are thinking about purchasing stocks, you can do it all from the same page or the same website. So let's talk about, let's talk about some of these scenarios here. So Gilead Sciences. A few years ago, Gilead came out with this drug called sofosbuvir. Sofosbuvir was the first ever cure for hepatitis C. So from 2011 to 2016, 5 years after they announced this, the S&P 500 went up 75%. In the same time, Gilead Sciences went up 257%. This is the type of return that you can get if you hit on an individual stock. It's very valuable if you can find this company and make it work that way. Nintendo, on the other hand, if you remember a few years ago, Pokemon Go came out. Pokemon Go was a huge hit. It shattered records for number of users. During that time period, in those short few days, Nintendo went up 72% in a few short days. Nintendo, seeing this, had to release a statement about what their financial forecast would look like now that Pokemon Go was out. Unfortunately, their statement said that they don't actually own Pokemon Go. It was a different company that owned Pokemon Go, and they were just licensing it. So immediately, Nintendo dropped several points. Now, there were a lot of people who started investing in Nintendo right around that time period where they were about to release a statement, because they put out a statement saying, we're going to talk about Pokemon Go and what this means. Huge flurry of cash went into Nintendo, and then you might have immediately lost 15% of your money. So this is some of the risk that you can have with individual companies. Now we talk about some of the ETFs. So these are pooled investments that you have instead of individual companies. Technology tends to be a very high growth, high risk play because you have tech companies that might potentially hit, or you have tech companies that might potentially fold depending on the adaptation of it to the general market. So if you were to go from 2008 to 2016, it was a huge raise. S&P 500 raising 55% over that time period is considered very, very good. In that same exact time frame, a technology ETF raised 225. So when the market's doing well, technology companies tend to do even better. On the opposite end, you have dividend ETFs. Dividends are paid by companies that tend to be very stable. Now, why do they pay dividends? If at the end of a year, a company has $100 million in profit, they can decide to invest that money back into their own company to allow them to grow further. Technology companies tend to do this a lot because they're constantly trying to innovate. A company like, and I'll use the example of ExxonMobil, there's not a lot of new technology coming out for the gas and oil business. So what they'll do is take that $100 million and they'll give it out to investors. So if you have a share of ExxonMobil, they're going to give you $5 instead of taking that money and using it in their own company. This tends to really stabilize the company because they're not going anywhere and they have a ton of free cash. So when there was a big recession like there was in 2008 and 2009, they tend to not dip as further down like the general market does. In the same way, when you have a huge upswing that we did in the last few years, they tend to not grow as much because there's not as much value for them to have that extra money and invest back into their own company. And then finally, the safest of them all, corporate bonds. Now, I talked about how corporate bonds you can now buy like stocks, the way ETFs are. If you were to look at 2008 and 2009, corporate bonds barely dipped down. You had a few companies that bankrupted, some large ones, some small ones. But overall, bonds are a safe investment that you can put your money into. So if you were getting close to retirement in 2005, instead of losing 25% of your investment like I showed in that initial slide, you would actually stay fairly even keel here. And that's the value of transitioning over to the safer investments as you get a little bit older on. Now, you don't want to put too much money in this when you're young because you still have time to grow and recover. That recovery phase that you had in these last few years, the corporate bonds didn't participate in that. So if you weren't thinking about retirement for 10 years and had all of your money in corporate ETFs, you wouldn't have been able to gain some money at that point. So this is kind of your spectrum of investments that you have. You have individual stocks, you have riskier, stable, and low-risk companies here. And you want to transition as you're investing from the risk taker side to the risk averse side, especially as you go towards retirement. This is probably my favorite new invention that's happened in the investment period, and they're called life cycle funds. And you'll probably see this when you start investing in 401k accounts that you're going to have when you enter residency. And I'll talk about that in a second. But the reason why I love life cycle funds is because they do all the hard work for you. So if you were to say that it is now the year 2020 and I'm going to retire in the year 2050 or 2060, you invest into the life cycle fund for year 2060. And what that fund will do is immediately allocate the right number of shares of stock to bonds as you progress further and further. So if it's 2020, you're retiring in 2060, and it's year 2020, they're going to put the majority of their money into stocks for you. And then as you get closer and closer to 2060, they'll immediately decrease the allocation to stocks and move a lot of that money over to bonds in the money market for you. That's a great way for you not to have to do the individual work yourself, but to let that retirement account sit there and do all of it for you. Employer retirement accounts. If you were to talk to somebody who retired recently, chances are that they have a pension fund. And the reason why is most individuals stayed at a company for 20, 30 years, and then they got a pension fund out of it. Now, we don't really do that anymore. Most companies give employee retirement accounts, and that's what you're going to encounter when you're out there. This is beneficial for you. It's beneficial for the companies as well. Problem is, most people don't know how to actually work with employee retirement accounts, and it's a shame because it will probably be the best way that you can plan for retirement. What is an employer retirement account? So you might have heard of these two statements, 401k and 403b. They're essentially the same exact thing, except 403b is for nonprofits instead of 401ks being for for-profit organizations. So if you're going to a hospital for residency and it's a nonprofit hospital, they're going to give you forms for a 403b. If it's a nonprofit, it'll be 403b. If it's for-profit, it'll be a 401k. So a 401k account is a retirement account where you put money into an account and there is a tax benefit for it. Taxes are generally somewhere between 25 and 40%. So if you're getting a tax benefit on this money that's going in there, you're immediately getting 25 to 40% money for free. That's why it's so important to think about an employee retirement account. So let's talk about an example. So if you were to take money, not think about the 401k account at all, and just invest it as if you would any other account. So if you were to put $5,000 at a tax rate of 30%, that means in a 401k account, you don't pay that money. You don't pay that 30%. It's a tax-free account. If it's a normal account, you pay that 30%, so now you're putting $3,500. We'll do the same start year and end year of 30 and 50 at our previous 8%. At 75, you're almost $600,000 better off because of this. This is why the tax retirement account is so valuable. And I can't harp on this enough. Now, the difference is, again, you save taxes, but you save taxes one time with a retirement account. You can either save taxes when you put the money initially in, like we are here, or you can save money at the very end. Now, of course, we live in the United States, and you can tax everything. So if you're gaining money on this retirement account and you take money out, that money is going to be taxed. So you have this let's say $1.7 million 401k account. That gets taxed at that 30%, so you end up with $1.2 million. The normal account gets taxed at the beginning, and it gets taxed at the end. So you end up with 800 and change. So this is a big reason why you need to put money into retirement accounts. Now, I talked about that difference. Getting taxed at the beginning when you put money in versus getting taxed at the very end. There are two different types of retirement accounts. One where you get taxed at the very beginning, and one where you get taxed at the very end. All right, okay, let's do this one first before we get to that. We'll talk about which retirement account to do in a second, but sorry, was there a question? Yeah. Yes.
So you drop from 1.6 to 1.2 if you take that out all at once, or is there a way you can take out a little bit at a time? So you're under, like, maybe if you take out just 50,000 a year, you won't be taxed as you, $1.6 million back.
It's a good question, and it's something that I'll talk about at the very end. As you get closer to retirement, most people's tax brackets actually decrease because your your income tends to be more based on your investments like this. Investments that you get from capital gains are taxed at a lower rate than your general income. So if you're taking money out of this at a smaller percentage or a smaller level, not all at once, you will get taxed at the same value, but spreading it out over a longer period of time will be beneficial for you because your investment will be over a longer period of time at that point. I don't know if that makes sense. Yeah. But it is beneficial. This is just a crude example, but I don't think you would take all of your money out at one point. You would take it out systematically. And at that point, still allow the rest of it to grow too. Any other questions? Yes?
So what's the difference between a 401k and a life cycle account? Are they the same thing, or is a life cycle account a normal account?
So it's a good question. A life cycle isn't actually an account. It's a type of fund that you can invest in, like an ETF. So 401k is where you put your money. Once you put your money into that 401k, you have to then buy stocks. You can buy ETFs, you can buy individual stocks, or you can buy life cycle funds. So one of my suggestions would be that once you have put money into a 401k account, to think about life cycle funds, especially if it's a retirement account and you're not going to touch that money for a long period of time. Employee matching. So I talked about employee retirement accounts being the most underutilized beneficial thing that you can do for your retirement account. And the reason why, I believe the number one reason why, is because of the language that's used for employee matching. It's extremely confusing. It's not usually helpful, but it's generally not that bad if you can kind of piece it all out one at a time. So we're going to give examples. This is taken from a residency benefits package that was given out. So the company will match half of up to 5% of gross salary with an evenly distributed vesting program of 5 years. This is what your program, when you get benefits at residency, this is what it might say. And you might be like, no way, I have no idea what this is. I'm just going to hold on to my money. And I wouldn't blame you because this is extremely confusing, but we don't want you to do that. We want to break this down and help you understand why it's beneficial, and this is actually good for you. So let's take this one at a time. Let's say you have $100,000 salary, and you want to contribute 5% of your salary into this investment fund. So that ends up being $5,000. So the company will match half of up to 5%. That means that they're going to put in your 5%, they're going to put in a half of that to add to your retirement account. This is the difference between pension funds and retirement accounts. In pension funds, they're saying at the end of retirement, we're just going to keep giving you money. Now companies are saying, if you put money into a retirement account, we'll throw in some additional money in there for you to help you out right now. So the percent that they're going to match is 2.5%. So you get an extra $2,500 on your retirement account for that 5% that you've put in. Now, if you were to do that math out, you would say that $500 of what they've matched is going to come out every single year. Said another way, they're saying that we're going to evenly distribute over 5 years what we're matching. The reason why they do this is instead of giving you that entire $2,500 up front when you put in that $5,000, they want to make sure that you stay at this company for a long period of time. So again, they're giving you all $2,500 at the very beginning. They're saying that over the next 5 years, we're going to give you $500 each year. So if you leave that company after 2 years, you're only going to get $1,000 of that matching dollars. But it's still worth doing because it's an extra $1,000 that you wouldn't have gotten. And of course, it's tax-free. So after your first year, you would have $5,500 because they would put $500 into that vesting. At the end of your 5 years, that initial $5,000 that you had contributed to this account would actually be $7,500. Let's do a different example. Let's say your salary is still $100,000 and you're putting in 4%. Here, half of up to 5%. So 4% is still less than 5%. So they're going to match half of that, 2%, which will be $400 every year. So now you get $4,400 in that first year and $6,000 overall. How about if you wanted to put 10% of your paycheck into it? Well, they're only going to match up to 5%. So you're still only going to get 2.5% of it. It will vest $500 every single year. So at the first year, you'll put $10,000 of your own. You'll get $500. At the end of 5 years, you'll get $12,500. So the language for this matching, employee matching, tends to be very confusing. Please try to break it down into the individual components and think about how it might benefit you. Because putting money into this is free money and it's tax-free, which helps you a lot in the long term. Now, I talked about getting taxed at the very beginning and getting taxed at the very end. The difference in that is not actually very subtle. It's huge. There are two different retirement accounts. There's a traditional IRA account. And the traditional IRA account was kind of the example that I gave you before, where you don't get taxed at the very beginning. You get taxed at the very end. The opposite of that is the Roth IRA account, where you get taxed at the very beginning, but you don't get taxed at the end. Now, why this is so important, why I think it's the best retirement account, is because when you're starting to invest right now at a young age and you're letting it grow for 30 years, putting in this initial tax value or paying the initial tax right now or when you're in residency won't be very high. Unfortunately, your residency salary isn't going to be super high. So your tax bracket isn't going to be super high. So you'll get taxed at a low rate right now. Then when it's grown to however many millions of dollars it will be, it can't get taxed at all at the very end. So all of that money is yours. And that subtle difference is huge when you start investing early on. And it's especially important for physicians. And I'll tell you why right now. Tax-free, like I talked about, you can invest in nearly any fund or stock, which is a huge benefit, or some of the traditional IRAs don't do that. There's a limit on when you can use Roth IRA accounts. You're only allowed to put $5,000 a year, and once your income is greater than $200,000, you're not allowed to participate in it. The average salary for pretty much every physician across the board tends to approach $200,000. So if you're making more than that, you can't utilize this. So during residency, this is going to be exceptionally important for you to try to take advantage of it. You also don't need an income. So if you had a gift of $5,000 that you received from your grandparents, you can put that money right in now into a Roth IRA account. Let's think about the difference between a traditional IRA and a Roth IRA. So let's say $5,000. In a traditional IRA, you wouldn't have any sort of tax that you would pay on that. In a Roth IRA, you would pay the general tax that you pay at that time period. 20% is actually a pretty good estimate for what you'd pay during residency for a resident salary. So your yearly contributions, $5,000, $4,000. Now I've used a start year of 30 and an end year of 35. Let's say you start residency at 30 and it's a 5-year residency. We'll say the same 8%. At 75, you've saved close to $700,000 versus $550,000. Traditional IRA account, now you have to pay the taxes on it. So you say you have to pay 35% on that tax rate. You get to $447,000, but you don't have to pay anything on your Roth IRA. So you get to $550,000. It might not seem like it's a big deal, but these are all fake numbers. When you actually start playing with real money and money that you'll be investing in, that's going to matter quite a bit. So this is kind of again, a large spanning introduction to everything related to investing. It's a foundation and hopefully a start for you to start thinking about it, because I hope that the decisions you make into what you want to go into don't revolve around money and you never feel like you didn't save well enough for retirement. If you have any questions, I'm happy to stick around. Thank you. Yeah.
If you're thinking about investing in something that like tracks, let's say the S&P 500, does it make a lot of sense to wait for there to be a dip in the market before investing?
Yeah, that's a good question. Yes and no. It's always good to get going. I think that if you wait for a certain time period, you're never going to be able to time the market. Do I think today would be a great time to do it? Yeah, sure. The stock market went down 4%. It might be up 5% today. It might go down another 4%. You never really know. Same thing with a giant recession. If you were to say that it would be a great time to invest in 2008, you also wouldn't have realized that it went down in the first half of 2009. I think that getting invested and getting started is the hardest thing, and I would just get going. Not with loan money, I have to say. All right, thank you. And I'll be up here if anybody has any individual questions.